Good morning.
Good morning.
So I've got a little bit of a bad throat. You'll have to tolerate me. And got a lot of slides I'll take you through very quickly. Those who want a copy, we shall make them available to you. And what I want to do today is to talk about intent and strategic intent. Where do you want to be? And we recently wrote an article that we called Backcasting as opposed to forecasting. Imagining where you want to be and how are you going to get there. And, working backwards in effect. This room that you're sitting in and this institution that you're in, it started with a lot of strategic intent. Our goal was always to be one of the best in the world, not the cheapest, not frugal. We wanted to be the best amongst the best in the world. And that meant that we needed to invest our time and energy in research. And it's not just, global research. We also need to look at how India is different. So we just can't keep borrowing textbooks and things like that from the West. We have to generate our own way of thinking. So what you will see in the next 30 minutes is, what we were really up to. And you'd be glad to know that our alumni, which is, we can call them our product, you can call them our asset, they're amongst the best in the world. LinkedIn ranked us number 5 in the world, not in India, and number 5 in the world. And we are, right behind the Stanfords and the Whartons. And that is because of what the students have done, not necessarily what we just taught them, but what they did with what they learned in ISB. And it is their strategic intent to perform. Many of the unicorns, they have their origins in the IITs, but they come to ISB, and we bring in the technology and the management together. Financial Times has recently taken us about 15 ranks from 27 to number 12 in the world. So why is all this happening? It is again because of what the institution wanted to do. I'm especially delighted to see the number of people in this room. It was only about 6-7 years ago that myself, Raji Pawar, Srini Raju, G.V. Prasad were kind of designing this place. And this place is designed as an executive center. The reason is that we want to bring together the corporate sector and the academic people together. So the idea is that if you look at an institution that begins to integrate what is happening or what should be happening in the marketplace, and this is an opportunity for us to, today's meeting is really all about that, putting together academic thinking, as well as corporate thinking. So with that, let me talk about changing mindsets. What we do at the Center for Business Innovation is we want to go up the value curve. It is not about cost minimization. It is not about assembling Apple phones in India. It is going up the value curve to design. It is designed in India, manufactured in India, and distributed to the world with the idea that we're going to need to become global brands. What we're doing at the center is, we can do a lot of things, but we want to focus on technology as a driver. We're not looking at technology destroying jobs, but technology as a driver to help us reach the top. And then what we're primarily looking at is how do we drive business value? And business value is not about EBITDA. It is about capitalization. What is going to lead to the market value of your dreams. So with that, let me spend just a couple of minutes talking about what drives market value. This is the work, by the way, that I've been doing for the last 35 years, so this is not new. What I've got at the top is something called the price-to-book ratio. The price is the market value of a company. The book value is the balance sheet value. It's the assets plus retained earnings. When you look at the NASDAQ, the price-to-book ratio is 4.16, meaning at least 75% of the value of the companies on NASDAQ is not on the balance sheet. When you come to the National Stock Exchange, and we have National Stock Exchange here, this number may have changed a little bit because of fluctuations in the stock market. But again, even in India, less than 75%, less than 25% of the value of the companies is on the balance sheet. I'm delighted to say that when you look at the Indian Stock Exchange And when I compare it to the London Stock Exchange, we are doing a heck of a lot better than London does in terms of valuation issues. Right now, what is happening is that a lot of the value is intangibles. It's the value of customers, it's the value of the potential money you will make, not the money that you have made in the past. And so you'll be amazed to know that the price to book ratio, the market capitalization of Apple compared to the balance sheet value of Apple is 55 to 1. Less than 2% of Apple is on the balance sheet. So you got to ask what the hell is going on. And what is happening is that when Apple comes, I don't even know where they are, whether it's iPhone 19 or 18 or 17. Whenever they come out with something, many people line up. And then we pay a huge premium. There's not that much of a difference in terms of cost, but we pay a huge premium for Apple. And then Apple slows their phones down, so you'll buy a new one. And you know it. And then they have got a different wire for charging, so it's not compatible with C-types. And you know it, and when you lose your wire in the hotel, you're happy to pay $79.99 for it. Okay? So what they're doing is making you happy, and they're making themselves happy. Okay? Microsoft is 11 to 1, less than 10% of Microsoft is on the balance sheet. Amazon, 7. Central recently published a paper titled, Do You Have an India Strategy? And it's not just a technology products. It's also, let's say, financial products. MasterCard has a price to book ratio of 62 to 1. Okay? This is a financial company, less than 2%, 1.5% of MasterCard is on the balance sheet. The value of MasterCard lies, how many people on here have a MasterCard? Okay? It's in the millions of users, the hundreds of thousands of banks that issue them, and the millions of people that accept it. All right? But we published this paper titled, Do You Have an India Strategy? So about 2 years ago. And what we discovered is that it is not just the techies. It is not the companies like Amazon. When we start looking at Indian companies, Nykaa has a price to book ratio of 55. It's not just Apple. So let's enjoy that. When we look at Titan owns Tanishq, 27 times book value, 4% of Titan is on the balance sheet. So what have they done? See, I want you guys to start imagining what you could do in your business to drive future cash flows. This valuation is dependent on not the EBITDA. It's dependent on what the investors think you're going to be doing in the future. Take TVS Motors. Their price to book is 21. Again, 5% of TVS is on the balance sheet. Now I want to give you a number for Volkswagen. If TVS Motors is 21 times book value, what's the value of Volkswagen? Turns out it is 0.4. 0.4 times book value. So what is happening? The future seems to be with TVS, and Volkswagen is in a bit of trouble because they invested in ICE machines from the past. Okay? So with this idea, do we have an India strategy? I want you to understand there's a lot of opportunity in India, and we don't have to always be pricing low. A colleague of mine, her namesake, Anup Srivastava, he's a Canadian professor of accounting. He's a professor across multiple Canadian universities. He, wrote a paper really, on talking about what does a 20th century corporation look like and what were the assets. Out there, assets are factories, inventories, and things like that. When you look at the 21st century corporations, the value is in the brands, the value is in the distribution networks, the value is in human capital, the value is in your IP. Now just imagine if I say human capital versus labor cost. When you hear the two words labor cost, what comes in your mind? Kam karna hai. When you hear human capital, invest karna hai. Okay? Very, 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 very different ways of thinking. The value is going to be in social networks and media. You may not realize it, but 93% of Google's revenues is advertising. It's a giant advertising company pretending to be a tech giant. Okay? But the money is coming from advertising. Now the problem is that when we look at EBITDA, our mind is that we need to produce EBITDA. Everybody's telling you. If you spend money on R&D, you're reducing EBITDA. If you spend money on marketing and building markets, you're reducing EBITDA. So in the process of producing EBITDA, what you're doing is you're sacrificing your future. Right? So I'm going to give you today a very, very quick look on several Indian companies, and there's one external one, ESPN, but after all, they broadcast cricket, so they're half Indian anyway. Okay? So I'm going to give you a sense of these companies, what they've been doing. But the problem really is that when we look at this S-curve, what we are doing is we have a fixed mindset. We use a centuries-old model called the DuPont model, where we talk about asset and turnovers. This model was developed in 1917 by the DuPont company, and they had the one main customer at that time, which was the US government. They had one main product at that time, core product. It was basically a product that was used in munitions, a 5 centuries-old product called gunpowder. There's no IP related to it, and if you're going to make money, how do you do it? By reducing cost. And if you have a factory making gunpowder, run it on 3 shifts and have a larger factory. So this was the mindset. You think of the asset turnover, but if today your asset is your customer, which is going to be in consumer goods, what do we mean by asset turnover when we come to customers? It means cross-selling and upselling. As simple as that. How do we utilize that asset? Right, so what I'm suggesting is that this works actually okay in product markets that are mature. It does not work upfront, which is where you guys are. If you guys are going to grow, you have to invest in product development. You have to invest in market development. It's as simple as that. And that is not going to help you maximize EBITDA. So in 2021, McKinsey wrote a study where basically they said, look, what does the value of your company depend on? Is it on EPS growth? Is it on revenue growth? Or is it growth in economic profits? Economic profit is profits minus the cost of money used to produce those profits. So it's above the cost of borrowing. What turns out is that EPS growth, or EBITDA growth if you want to call it that, explains 12% of the value of companies. Revenue growth takes you up, EPS plus revenue growth takes you up to 29, and EPS plus growth plus revenue growth plus growth in profitability takes you up to 43%. Remaining 57% is still not explainable. But what McKinsey was saying is that, look, you need to focus on growth, and you need to focus on growth, growth, and growth. Okay, this is now 1994, I edited a special issue of the Journal of Marketing Research. This is one of our top journals in marketing. And what we came out of that is, look, we need to create structural barriers to competition. If it is a very efficient market, and if I have a good idea, you being smart enough, you'll copy it. And the customers being smart enough will say, okay, Raj's product is no different from your product. So we will compete with each other on price. We do not want to compete on price all the time. Because if you're competing on price all the time, you have no margin left. You might remember from your basic economics course that in perfect markets, marginal revenue is equal to marginal cost, which means marginal profit is Zippo. That's not going to work. So what we're trying to do is to create structural barriers. Apple is a near monopoly. Okay? How many of you use Microsoft Outlook? Okay. What happens to your loyalty? If I came up with a new operating system, a new platform for your mails, etc., how many of you are going to switch? Not too many. So rumor has it that Microsoft has a customer retention rate of 99%. The remaining 1% is resting in peace. Okay? If that is the case, what they've done is they've created a structural barrier to competition. At the moment, it so happens it's legal. A brand is a legal barrier to competition. But that is being debated by the European Union as well as the Federal Trade Commission in the United States. So what we did, this is 1994, 31 years ago. We said the main drivers were value creation and value appropriation. Creation was coming from differentiation. How are we different? Okay? And that was coming through market-facing processes. Product development, supply chain management, and customer engagement. These were the three main processes. The second part of it was building the reputation to appropriate the value. If I show you these logos, do I need to tell you which companies they are? The answer is no. So we talked about MasterCard already, but look at Nike. So how many people here wear Nike shoes? Many of you? I was asking my students, I don't wear Nike, I wear something called Skechers. These are kind of cheap compared to Nike. But I asked my students, how much did you pay for your Nike shoes? They said about 10,000. 10,000. It turns out Bata, similar shoe, is 2,000. What's the difference in cost of production between a Bata shoe and a Nike shoe? They were probably outsourced to the same manufacturer anyway. So there's not much difference in the cost of production, but there's a big difference between 8,000 and 2,000, I can tell you that. And with that difference, what can you do? We can spend it on design, we can spend it on advertising, and we can expand it into related markets. So Nike is not just making shoes, they're making all kinds of other things that you wear. And I'm willing to bet that many of you who raised your hands, if you opened your closet, there'll be 10 shoes. When I was growing up, we had 2 shoes. Black shoes to wear to school, and white shoes as called Keds. So you can also see how the consumption value has gone up. So I'm going to take you very quickly through ESPN. It's the only non-Indian brand I'm going to talk about. They started in 1978. They had to make an investment. They had to pay to be able to get cable operators to cover them, and they covered the NCAA's National Collegiate Athletic Association, and they broadcasted the basketball games. Then they moved into football and the NFL draft in 1980. And in 1987, they opened the ESPN Sports Center. ESPN Radio came into being in 1992. 1993, it was ESPN Channel 2. 1995, ESPN Sports Zone. And the website emerged finally. 1996, they started looking at ESPN News and ESPN Classic Sports. What is Classic Sports? All the inventory that they had, they were just simply rebroadcasting it, so they didn't have to produce it anymore. And then they came up with the ESPN magazine, and well, why not ESPN stores? Why not sell T-shirts and things like that as well? And then they started, acquiring the content rights to ice hockey teams, and they got a $4.8 billion NFL contract. Now, this sounds big, but when they started in 1978, 79, they had to pay the cable operator saying, Hamara will pay you to carry your content. All right? In 1983, they gained popularity, and then they were able to charge the cable operators 10 cents per customer. In 87, it went up to 20 cents per customer. In 1997, it went up to 62 cents per customer. At the same time, the number of customers is also growing. And then other people saw what these guys were doing. They're making money now, right? So everybody jumps in. Fox Sports and CNN Sports, etc. They started coming in. But nonetheless, these guys went ahead. And when they launched ESPN2, ESPN News and Classic, for ESPN, they had 73 million customers. Now, 73 million customers at 62 cents a month. Okay, 62 cents a month is about $7.5 per year. So you multiply 73 by 7.5, and you'll come up to upwards of $50 billion. Okay, that's the sorry, 50 million is the no. Yeah, 50 million is the cash flow coming. Anyway, by 2003, that 62 cents had jumped up to 2.45. The market is building up. The number of customers had then grown, I think, to 122 million. All right, so in a nutshell, in 1983, they tried to raise 200 million, and Time Warner said, go to hell, you guys are not worth anything. In 1990, Capital Cities ABC paid 850 million. So they were declined for 200 in 1983, but in 1990, somebody paid 850 million for them. By 1995, Disney paid 5 billion for them. Right? Then if we look at these numbers, 122 million customers at 245 per month multiplied by 12 months, etc., it comes to about 3.6 billion from that main channel. And 3.6 billion at a 10% cost of money is giving you $36 billion valuation. The reason I'm telling you, they started small. They had to pay somebody to carry this stuff. It wasn't easy. Now they are a very big name, but they were not always a big name. It takes time. They then expanded into China because one of the Chinese players was 7 feet 6 inches. And so that gave them entry into China. And then we know they went into football and then, of course, cricket. So this is global expansion. And what can we learn from them is that we have to invest time, and it is not going to be free upfront. SBI Yono, I worked with the managing director of Yono around 2018, and at that point in time, they had 17 million customers. There were 200 to 300 odd people that were working on the Yono project. This was out of 220,000 SBI employees. So you can do your own calculations, divide 200 by 220,000, and you get 1 out of 1,000 SBI employees were working for Yono. All right, what did these guys do? They basically took advantage of the India stack. It cost them $100 to acquire a customer, 100 rupees, sorry, to acquire a customer. And then what they were doing is they were cross-selling and upselling everything. So the customer who had a checking account, if they had a credit card, if they had automobile loan, if they had a home loan, if the home insurance, this, that, and the other. So what you're seeing is the numbers stack up per customer. There's a big literature on lifetime value of customers. And as they built this up, and then came the pandemic, and a lot of people shifted digital. So now Yono has about 80 million customers, 75 to 80 million customers, out of the 480 at SBI. So 1 out of 6 customers is a Yono customer at SBI, but I think they account for more than 60 to 70% of the value of the company. And are these customers valuable? Yes. They can now turn to BMW and say, if you can give our customers a 2% discount, we'll send out an advertising message that you're giving them a 2% discount. And by the way, while we're doing that, can you give us 0.5%? Okay? So this is B2B B2C being converted to B2B. All right? So if you look at what has happened, people don't realize that State Bank of India is the 3rd most profitable organization in India, only 3rd behind Reliance and the Oil and Natural Gas Commission. The 3rd most valuable. But the number 3 amongst banks in terms of valuation, number 3 behind HDFC and ICICI, and what is happening is that they have to carry the load of 20,000 branches and 220,000 employees. So I'll leave it at that. What we need to do is we need to be looking at the future And about 7 years ago, I made the comment, could UNO be more valuable than State Bank of India? And my answer is yes. I've got somebody from stock exchange sitting here, and if they did not have the burden of 20,000 branches and 220,000 employees, they will be 3 times the value of HDFC. Okay? TVS Motors, going to run through them. They've been building their arsenal by doing research over time. They're one of the best companies when it comes to racing level two-wheelers, and they've been doing it not now, they've been doing it for 30 years. And it has come to the point that the world is beginning to recognize them, and what is happening is that they are now providing the hardware, if you want to think of it, around the world. This is similar to Samsung. They started out as a contract manufacturer. Then they became an original design manufacturer, which is what TVS is now. It took Samsung another 5-7 years to build the brand name. Now imagine if these guys already have a valuation of 20-1, if they're now also able to build a global brand, they will become like Nike with a valuation of 60-1. And they're in the global market, and it really helps that India is the largest market amongst the global markets when it comes to two-wheelers. So that doesn't hurt. So what is also helping is being in India, right? If you look at the valuation, they've gone up in value by 500% in the last 5 years. Okay? NSE is nodding the head. Okay? So you like champions like this, right? All right. Apollo. I'm going to run through this very quickly. Basically, they're running a flywheel. The hospitals to this, to pharmacy, they're going round, and round, and they built up the ecosystem, the healthcare ecosystem. They're all over the ecosystem. What has happened to? They have the largest, bed capacity in the healthcare area. They have the highest level of revenue, and the stock has been going gangbusters. And these guys have grown 361% over the last 5 years. Again, one more champion. India is a vast market. You guys have a great opportunity. We just need to figure out how to fund the future. All right? Give you some other examples. Shree Cement, I see only have 2 minutes left. I'll talk faster, right? So Shree Cement, the co-chair is one of our alums. And I was asking him, what has led to the growth of your company? And their price to book ratio at the time I called him was running at 7.7 to 1. It's now about 5 point something because the Adanis and the Ambanis have also kind of joined in, and Birla's was already there. But what you see on the left is a chart. He said, look, so it's very simple. We took our capacity and we roughly went 50 times the capacity over a period of 15 years. So what is happening is, again, growth, and growth. So Shree Cement, now let me go to JSW since I'm running through everybody. JSW is also been investing in growth. And what has happened is they have now become the world's most valuable steel company. Out of the top 5 steel companies in the world, 3 are Indian. Okay? Again, I'm saying, I come from Lucknow, and when I was growing, we used to, speak Lucknowi or whatever. Himmat se kaam karna padega. Okay? So these guys are growing, and JSW Steel's at the top, ArcelorMittal, then you got Tisco. But now JSW has entered. They bought MG for India. Now, what the hell do you do with steel? You see this flywheel going? Okay. Nika. When I was growing up, my mother went to Chowk in Lucknow to buy jewelry for my bhabis to be. Then if you're living in Delhi, we went to Chandni Chowk. If you were living in Srinagar, you went to Lal Chowk. You went Chowk, and you went Chowking. Okay? What Taresh said, look, you don't have to go to the same person. It's all a question of trust. You buy from us, we take it, we buy back. They issued a certificate of authenticity, and that enabled them to grow national, and now they're international. And Tanishq, which is owned by Titan, the company Titan, they are worth $41 billion. This is the same valuation as Maruti. Okay, so it's not everything that is visible to you. There's an India that is emerging. You know, if you look at these guys, or if you look at Nika, it is not Mumbai and Hyderabad and Delhi Shahar. It is the tier 2 towns and the villages, etc., that are coming into a market. Then, this is going to be my second last slide. 1990, I showed you the McKinsey research from 2021. In 1998, I published a paper called Market-Based Assets and Shareholder Value. Market-based assets are not inside the company. They are distribution networks, your strategic partners, your customers, your brand. These are not on your balance sheet. These are market-based assets. And what I said was that market-based assets enhance cash flows. You know, the fact that you're willing to pay more for Apple is saying that. Market-based assets allow you to accelerate your cash flows. The fact that you're willing to stand in line to buy Apple 19 or whatever it is proof of their testimony. By the way, this kind of research we were doing in the 90s. In 1993, did some of this. Market-based assets do the customer lock-in, the loyalty. Customer retention, brand loyalty, two sides of the same coin. You can hang on to your customers. But then you need to come up with, what is the strategy that we're going to execute? Where are we getting product differentiation? What are we doing in the marketplace? What are we going to do to make these three things happen? So what I was saying in 1998 is that product development is an investment, it's not an expense. And market development is also an investment, it's not an expense. By the way, this has turned out to be the only paper in the 100-year-old history of the Journal of Marketing to win the Best Theory Award, the Best Practice Award, and 10 years later, it won the award for being the paper that had the most impact on marketing. Okay? So what you need to do, and these are the awards, what you need to do is a change in mindset. You know, you need to have an India strategy, not foreign companies having an India strategy. And you know, the GDP was growing at 7.2%, but that's for the country. In specific segments, I don't see any numbers out here that are less than 10 or 15%. In this market, this is a Nifty and Nifty 50 and Sensex. If you look at the index, they're going through the roof. But this is a picture from Holi. This was a picture from Diwali. But do you know which city it is? New York City. New York State declared Diwali a state holiday. And this is New York City. This is Mumbai. And then I was doing a program like this in Sydney in Australia. I told the Australians they just don't know how to celebrate. Okay? They have to pick up. And so this is our future. And in this future, the biggest mistake that you can make is not investing in the future and not being ambitious. The biggest risk is not taking the risk. Right? So I'm glad we have a whole bunch of risk takers. I apologize for running over time, but I only did it by 2 or 3 minutes. Thank you.